the like button for YouTube algorithm. Please subscribe. Thanks. Chevron. Bulls say. Chevron has accumulated U.S. unconventional acreage through smaller deals in higher quality plays like the Permian and Marcellus, thus avoiding overpaying and destroying value like many peers. Chevron should realize improved downstream earnings and returns as conditions in its California refineries improve and new chemical production capacity is added via its CP Chem joint venture. Growth is expected to accelerate beyond 2021 as Permian production could double while expansion at Tengiz and Nugum projects add volumes. Bears say. Chevron has a smaller downstream footprint than many of its peers, leaving it more exposed to downward fluctuations in oil and natural gas prices. The completion of Gorgon and Wheatstone significantly increased Chevron's exposure to LNG at a time when growing supply in the market could depress prices for several years. Chevron's focus on the Permian for growth could leave it exposed to cost inflation, given the high levels of activity in the region relative to other basins. Alternatively, it had a high decline asset that requires high levels of reinvestment. Analyst Ratings. Buy, 71%. Hold, 25%. Sell, 4%. Market cap, $163.58 billion. Average volume, 9.43 million. Dividend yield, 5.66%. Shell. Bulls say. Shell's efforts to reduce costs and improve capital efficiency should lead to excess returns on capital at our mid-cycle oil price of $60/barrel. This improvement is not being recognized by the market. As one of the largest LNG portfolio players in the world, Shell stands to benefit from the rise in global gas demand and likely recovery in prices over the next decade. Shell differentiates itself from peers with a large refining and chemicals segment, which should add enormous value in future years where oil prices are likely to remain volatile. Bears say. Shell's recent dividend cut and suspension of share repurchases leave its cash yield lower than peers. A third of Shell's refining capacity is in Europe, which lacks a cost advantage and where margins are likely to remain under pressure from low-cost imports. An oversupplied LNG market affects Shell more than peers, given the size of its portfolio. Lower prices, contract renegotiations on volume and price, and inability to develop future resources are all risks. Analyst Ratings. Buy, 38%. Hold, 62%. Sell, 0%. Market cap, $56.49 billion. Average volume, 4.07 million. Dividend yield, 10.02%. As always, be sure to let me know your thoughts down in the comments. Be sure to smash that like button. Thank you so much for tuning in, and I will catch you in the next video.